Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. The stock market is crashing yet again, exactly as we predicted last Friday. This move to the downside was 100% predictable, and I do mean 100%. And if you're not sure what I'm talking about, please check last Friday's video. The stock market today closed 1% after opening up, gapping up from last Friday. We opened 1% in the green, and then we completely erased that and ended up closing 1% in the red on all three major indices. Taking a look at the stock market map, we can clearly see red everywhere with a few pockets of green. Primarily, the energy sector saw a bounce today, some travel services, as well as some basic materials, specifically steel and copper. Big consumer cyclical names like Amazon, Tesla, and Home Depot opened up and then erased all of those gains and closed flat on the day. The healthcare sector saw massive losses today. Big tech names like Google and Apple saw significant losses as well. On the tech side of the equation, Nvidia was the only outlier, putting in a gain of 2% on the day. Moving on to the different sectors, energy was leading today, up 2% on the day. Basic materials up 0.7%. Cyclicals, communication services, real estate, and financials basically flat. Industrials, defensives, tech, and utilities were down between half a percentage point and a full percentage point. Healthcare saw the biggest losses, down 2% on the day after having made the biggest gains last week. Jumping into the daily chart of the S&P 500, we have this beautiful bearish engulfing candle where we opened 1% above last week's close. We floated around the top end of this range. We never got to put in a higher high. If you take a look here, guys, we had a high here, a lower high here, and then again a lower high here. So clearly bears have been feasting at this level right here, pushing the stock market down every single time we attempt to hold 390. We have not been able yet to hold 390 ever since this waterfall sell-off that we had towards the middle of June. The bearish case has been only growing stronger and stronger. And we did in fact call a local top right here last Friday. We predicted that the market would make its last attempt to push higher and then sell off. And it did happen exactly as we expected it would. So where do we go from here? Clearly the market wants to go down. After putting in 3 lower highs, we are likely to see the bears attempt to break this low again of $374 and try to fill this gap right here at the $366 level. We have a bunch of earnings coming out this week and next week, and as more and more earnings come in, expect a lot more volatility in the market. Now let's jump into the triple Qs. This is the chart for the NASDAQ. Again, we tried to put in a higher high. We failed. We have now put in 3 highs, and in our last attempt, we were not able to take back the 50-period daily moving average. The bears came in full force and defended this zone exactly as we predicted they would. In fact, we did call out this exact level right here. If you see this blue line, we had several reactions in this blue line in the past, right? We had a sell-off right here with 3 attempts. We had another sell-off right here with multiple attempts. And now we're seeing another sell-off at the exact same level in the channel. Now, I did draw this channel by hand and I did my best to connect the highs and lows. And going all the way back into January of this year, this channel has actually predicted price action perfectly. So again, where do we go from here? We clearly have this obvious gap to fill right here. We will see bears attempt to break this level right here at $280. And if this level is broken through, we will see a close of this gap at the $275 level. Now let's take a look at Apple. In my last video, I did call out a top in Apple right here. I drew out this resistance zone, which acted as support 3 times in the past. And once we broken through that support, back here in the middle of May, we have never been able to take it back. We sold off this level consistently. Bears came through every single time, and we did say that bears will defend this zone ferociously, and they did. In fact, I did open a short position right here on Friday that is now in the green. And I want to say a big thank you to all of you legends who have been supporting me and supporting this channel. We've been growing very quickly, faster than I predicted, and faster than the biggest channels in this arena, including amazing content creators like the Maverick of Wall Street, Figuring Out Money, and FX Evolution. We've only been putting out content for 4 weeks now, and I'm so thankful to all of you, and I'm so thankful to the amazing legends in the Discord group. We do have a tight-knit community in the Discord group where I post every single trade that I make. It's $20 a month, and you get to see every single trade and every single investment that I make when I make it. So it's a way for you guys to support me if you want to do that, and you get the value of actionable information on the stock market. So again, if you want to join us, you can find the link in the description. Now let's get back into it. The exact position that I opened right here, and that is now in the green, was actually put on Apple that expire right here on the 16th of September. So that gives me plenty of time to see some nice gains on those puts. I might even open additional puts if I see some strength come back into the stock, and I might go further out to October. Now let's jump into the $1 million chart that I showed you guys last Friday. This chart and the patterns that I discussed in this chart predicted every single crash in 2022 on the dot, every single top we've seen to date in the market, and this was no exception. We had this signal right here that I talked about in the last video, and it's almost like magic, guys. I swear to God, it's almost unbelievable how accurate this signal has been so far. And it's this, guys. What I discovered was that every single time we put in a low on the VIX with a lower low, and then we put in a bottom on the momentum right here, that would systematically correlate with a massive spike in the VIX and a massive sell-off. And I did point out exactly every single time that this happened this past year, and it happened 5 times so far, and it predicted crashes 5 out of 5 times. So today this signal has been 100% accurate. If you want to know more about this signal and how to catch it, please check out last Friday's video. Now I do like to add the S&P 500 here to the chart, so you can guys see exactly how amazingly accurate this signal has been so far, right? Just look at this. It systematically picked tops right here on the 3rd of January, again on the 9th of February, and yet again on the 4th of April, 8th of June, and again on the 15th of July last Friday. And in fact, every single time we've put in a double bottom on the VIX, with that specific structure that I talked about, we had a double top in the S&P 500 followed by a sell-off, a double top, and then a massive sell-off, another double top right here, massive sell-off, a double top right here, massive sell-off, and then a double top again with a massive sell-off to come. I do expect the selling to continue all the way into September and in fact into October. We will see a prolonged period of weakness, and it has to do with this, guys, seasonality. Now we are sitting right here towards the middle of July, the back half of July. In terms of the earnings cycle, this is a spot that is very similar to right here towards the end of March. And if you guys all remember, we never ended up having this April rally that is typically seasonally expected because we had terrible earnings, and I do expect to see the same thing right here. I do not expect to see the second leg in the rally, and I do expect to see the sell-off to begin now and last all the way into the end of October, right up until those election results come out, and hopefully then we will see a nice November-December holiday rally. And generally speaking, guys, during midterm years, we do put in a lower low in the back half of the year, right? That undertakes that low that we put in June, right? So I do expect us to at least hit $350 on the S&P 500 and perhaps even go all the way down to $320. And the technical picture on the S&P 500 does support that. We have this 200 weekly moving average sitting at $350. We could actually hit that as soon as August. And then we have this cluster of price action sitting right here that bottomed at 320. So we could see the market visit that price action again towards the end of October or end of September even. It definitely matches up with seasonality and this technical downward channel that we've been in throughout this year. Now let's take a look at the HYG, the high yield bonds. This was another absolutely beautiful signal that told us to get out of the market and switch back to being short. And in this chart, I did spot a 5-phase pattern that occurred exactly like what we are seeing today back here during the last earnings period in Q1, right? We had a period of strength, weakness, strength, choppiness, last bit of strength, and then a massive sell-off. It occurred in 5 phases. Same thing here. Phase 1, we go up. Phase 2, we go down. Phase 3, we see a bit of recovery. Phase 4, we chop sideways, right? We end up exactly where we started. And in the last phase, we see the last bit of strength. And we're getting a rejection exactly where we expected, very close to this 50-period daily moving average. You can find the same pattern on the momentum indicator as well, right? Strength, weakness, strength, prolonged weakness. So 1, 2, 3, 4. Same thing right here. Strength, weakness, strength, and a prolonged period of weakness now, right? 1, 2, 3. And we're now entering the 4th period of momentum, where momentum is expected to weaken significantly and where we are expected to take out this low. And remember, guys, high yield bonds move in tandem with the S&P 500, right? So let's add the S&P 500 to this chart, move it right here, take it there. And look at that, guys. We move exactly in tandem. We go up and down in tandem because both of these assets, the S&P 500 and the high yield bonds, are recognized as high risk assets, right? So they move together. And as the saying goes, bond traders are generally smarter than stock traders. So sometimes, in fact, many a time, you will find that the price action in the S&P 500 is not confirmed by the price action in the high yield bonds. And what ends up happening is that when you see weakness in the high yield bonds, you see that follow in the S&P 500 straight after, right? Now let's take a quick look at a few charts here. We have the 10-year yield. The 10-year yield is calming down. This should have been conducive to a stronger rally in the stock market, but we are not seeing that because of the underlying weakness in the earnings and the underlying weakness in the economy itself. So we might doodle around here at 3%. And we might go even higher toward the end of the year as the Fed continues to raise interest rates. This is the XLE, the S&P 500 energy ETF. We are beginning to see some positive momentum here, a bullish crossover. We did call out this positive divergence on the momentum and the price action. We put in consecutive lower lows, once, twice, 3 times, and then we put in consecutive higher lows on the MACD. That signaled a pop in energy. How sustainable this pop is, it's really difficult to tell, right? We have inflationary pressures continue, and then we also have some deflationary pressures coming in from those interest rate hikes by the Fed, as well as the weakening economy and significant weakening in the Chinese economy as well. Now let's take a look at oil. We've seen a pop in oil as well as a pop in copper. It's really difficult to tell if these are just dead cat bounces as of right now. But I definitely do not expect that oil prices will fall off a cliff or anything like that anytime soon. Supply and demand dynamics are still there. Demand is still outstripping the available dwindling supply. So despite the weakening global economic outlook, I do not expect oil to drop by that much, right? I do expect us to maintain these levels for a little longer. A few more charts I have for you guys. This is GameStop GME. We have the split coming in on the 22nd of July. Despite the weakness that we've seen in the stock market, we're seeing GME continue to show strength. Now, we did see a similar pattern back here, guys, towards May of 2021. When the stock market was actually showing weakness and GME was doing the opposite. It was moving as the inverse of the stock market. This sometimes happens with GameStop. It's a weird one, right? But I do expect weakness to come back into GameStop as soon as that split is out of the way. On AMC, we are still seeing this strength. We had this bull flag. We had a bunch of indecision candles here, and then we made a decision to the upside today, despite the weakness in the stock market. This is a highly, highly unpredictable stock with very expensive options. So I'm a bit averse to trading AMC, but on the technical side of things, I do think that the 200 daily moving average might be in play. We could see a touch here. And if we do end up touching the 200 daily moving average, that would be a great time to take profits and get out of this trade if you are in it. Moving on to earnings, we have a bunch of earnings coming out tomorrow. We have Johnson & Johnson, Halliburton, and Netflix. On Wednesday, we have ASML on the semiconductor side. We have Tesla. We have United Airlines. And on Thursday, we have American Airlines, Snapchat, Nucor, and Dow on the industrial side of things, the basic materials industrial side of things. And on Friday, we have Cleveland Cliffs and American Express, as well as Schlumberger and Twitter. These earnings will be the biggest ones that I'll be following, right? I do expect some strength in Johnson & Johnson. The healthcare sector has just been showing a lot of strength recently. I do expect strength out of Halliburton as well, because even despite the fact that oil prices have gone down, they are still holding that $100 level. Netflix will probably be a mixed bag. We will see what happens with the introduction of an ad tier. I do expect ASML to do well. Last week, TSMC reported, the largest semiconductor manufacturer in the world, and they did really well. And in fact, they raised their forecast. So I do expect ASML to do well. Tesla will be really interesting. We did see those China lockdowns affect Tesla production and sales. The problem with Tesla is the stock itself. It's the valuation of the stock. It's so high. So even if Tesla manages to beat on earnings, the stock could still go down. In fact, the last couple of earnings, Tesla beat, and the stock still saw a lot of selling after the earnings dropped. Moving on to Nucor and Dow. Nucor, I believe, is the largest steel manufacturer in the United States. And we did see commodities crashing over the past 6 weeks. So I do expect Nucor to give miserable guidance. American Airlines would probably also talk about how their expenses are rising and how fuel costs are very, very high, and that will probably eat into their profit margins. Snapchat will also probably see some weakness due to declines in ad revenues and ad sales, right? Because the economy is weakening. But Snap could still see some positive momentum because the stock has been beaten down so hard. I would not bet on Snap either way, to be honest. Cleveland Cliffs will probably also report weakness, again due to massive declines in iron ore prices. American Express, I expect to report a weakening consumer, growing delinquencies, and an expansion of bad debt. Schlumberger will probably do well, again because energy prices have managed to stay near their highs. Twitter will be absolute insanity, right? We have this massive fight between Twitter and Elon Musk, and it's honestly just a clown show. It's fun to watch, but I'll just watch from afar, okay? I do not like to get into things like that. On the economic side of things, we had the home builders index come in today, 55. Massive weakness versus the forecast of 66. This is honestly to be expected. Mortgage rates have more than doubled so far, so a weakness in housing was totally expected. Building permits and housing starts will probably also go down. Home sales, I do expect that number to be very weak. Jobless claims and continuing jobless claims will also probably see a tick higher as companies continue to cut jobs and freeze hiring. I do expect the jobs market to show some softening. Other than that, this week will be driven by earnings. That's all I have for you today, guys. Thank you so much for watching, supporting, liking, subscribing. You are absolute legends. Thank you so much, and I'll catch you in the next one. Bye-bye.
Oh, wow!